You've heard of value traps and growth traps, but there's a third type of investment trap that quietly destroys portfolios. It's called a quality trap, and it might be the most dangerous of all because it disguises itself as your safest investment. I'm going to show you exactly what quality traps are, how to spot them before they wreck your returns, and the specific metrics that can save you from this costly mistake. A value trap looks cheap on paper, low PE ratio, low price to book, but the business is so fundamentally broken that you're actually paying a premium for a company headed toward bankruptcy. Think of a struggling retailer that looks statistically cheap but is losing market share to e-commerce. A growth trap is the opposite problem. You knowingly pay a premium multiple because you believe the company will grow so fast that today's high price will look like a bargain in 5 or 10 years. But when that growth doesn't materialize, the market punishes the stock with a brutal re-rating. A quality trap combines the worst of both worlds. You're paying a premium multiple like with a growth stock, but you're buying it because you believe the company has an enduring competitive advantage, a moat that will protect high returns forever. Now, the trap is that moat is actually crumbling, and you're about to watch your safe quality investment turn into a value destroyer. Quality companies tend to consistently have high returns on invested capital, or ROIC. When a company can take $1 of capital and consistently turn it into $1.20 or $1.30 of value, that's the hallmark of a competitive advantage. Investors are willing to pay premium multiples for these companies because they believe the competitive advantage is durable. High ROIC typically leads to above average earnings growth and significant free cash flow that can be either be reinvested into more high returning opportunities or returned to shareholders through dividends and buybacks. Think of companies like Microsoft and its Azure business or Visa with its payment network. These aren't just good businesses. They're businesses with structural advantages that competitors can't easily replicate or compete with. A quality trap is a company that looks like a high-quality business with high ROIC and an apparent competitive advantage, but that advantage is actually deteriorating. The high returns are slowly eroding away, leading to lower than expected earnings growth and a painful re-rating of the market multiple. Research from Michael Malbison and Dan Callahan shows that companies with declining ROICs produce poor returns over 3-year periods. The market is usually slow to recognize when a quality company is losing its edge, which creates the perfect conditions for a trap. The decline can happen for several reasons. A company might be investing in suboptimal projects with lower returns, and their current high ROIC is coming off old investments or old assets. There could be a significant change in capital allocation strategy, or most dangerously, the company could be losing its competitive advantage due to disruption, new regulations, or changes in consumer behavior. The key to avoiding quality traps lies in understanding return on incremental invested capital, or ROIIC. While return on invested capital looks at historical returns, return on incremental invested capital tells you about the returns on new capital investments. This is your early warning system. You're going to take the change in operating profits over a period and divide it by the total retained capital for that same period. For example, if profits grew by $1 billion and it took $5 billion of retained capital to generate that extra billion, your return on incremental invested capital is 20%. High returns on incremental invested capital indicate that a company's new projects are generating returns above their cost of capital, reinforcing their competitive advantage. But a low or declining return on incremental invested capital, that's a red flag. That's the company is either investing in poor projects or losing its competitive edge. Since 1-year returns on incremental invested capital can be really lumpy, you want to look at 3 and 5-year incremental returns. And you want to compare returns with and without goodwill to get a clear picture of true operational performance. Another critical metric to watch is gross margin direction. Gross profit margin is the purest expression of customer valuation. It shows the premium buyers assign to your product over raw materials and basic manufacturing. Gross margins that are higher than industry peers and remain stable indicate a sustainable competitive advantage. Sustained expansion is even better. It's a signal of growing pricing power and market strength. But declining gross margins, that's a warning sign that the company has lost control over a major cost input or is facing pricing pressure from competitors. When gross margins shrink, there's less profit available to reinvest in R&D or marketing to strengthen the company's competitive position. And quality traps are dangerous precisely because they masquerade as safe investments. But now you have a few tools to spot them. If you want to dive deeper into quality investing and learn more advanced screening techniques, I send out detailed analysis and investment frameworks every week in my newsletter. You can sign up for free at incrementalreturns.co. There's a link down in the description too.